Imagine watching a market where conviction and capital meet infrastructure and narrative. Binance Coin BNB has quietly moved from being just a venue token to a strategic asset at the center of an expanding on-chain economy. Shift is what underlies the claim that BNB could become the golden gateway that opens the next broad altcoin season. Right now, the story has several clear pillars. Market leadership and scale. BNB's market cap sits north of $110 billion. It's putting it in the same league as some major public companies and even surpassing household names recently. Broad ecosystem. Utility from trading fee discounts to staking, DeFi NFTs, and RWA integrations. An aggressive and transparent deflationary mechanism, quarterly burns that are permanently removing supply. And a nascent wave of institutional treasury buys that signal a meaningful change in how corporations and funds view the asset. These forces combine to create a powerful narrative. When an exchange token like BNB has both deep utility and widening institutional acceptance, it can act as a capital magnet, not only drawing direct investment into itself, but also routing attention and flows to the projects that live in its ecosystem. The numbers and events that underpin this thesis are concrete. Live market data shows BNB trading around the low to mid-800s with a market cap above $110 billion, a level that has in recent reporting eclipsed the market caps of well-known public firms and established the token as one of the largest digital assets by valuation. That scale matters because it allows BNB to act as a stable hub. Deep order books, institutional custody interest, and real utility make it a far more credible gateway than smaller, less liquid tokens. Institutional signals are especially notable and should be treated as a regime change rather than a one-off headline. Publicly announced corporate treasury moves, such as a NASDAQ-listed entity allocating hundreds of millions to BNB and another firm committing hundreds of millions to BNB reserves for its treasury, move BNB from an object of retail fascination into the domain of corporate treasury strategy and institutional balance sheet planning. Those reports have real teeth. When corporations formalize a treasury strategy around a single digital asset, they reduce exchange float, create longer-term bid pressure, and change the expectations of other corporate treasurers who may have been waiting on the sidelines. That behavior was visible recently when a listed firm announced a 200,000 BNB purchase for roughly $160 million. A move framed as a strategic pivot toward building a BNB treasury. When another company publicly committed to a multi-$100 million BNB treasury program. These discrete flows are the kind of structural demand that can underpin sustained price appreciation if they continue, or if many more firms follow suit. The chain-level mechanics reinforce the thesis. BNB's tokenomics include scheduled burns that permanently remove supply. And the burn totals in recent quarters have been eye-watering, burning more than 1 million tokens in a single quarter with dollar values in the high hundreds of millions. Around 1 billion has the mechanical effect of tightening outstanding supply as on-chain activity grows. This supply squeeze, combined with growing utility BNB, remains the fuel for fees, staking, and an ever-expanding set of applications on the BNB chain. Creates a classic demand-met-scarcity setup that historically supports higher valuations across asset classes. If the ecosystem continues to attract developers and projects, DeFi protocols, NFTs, gaming, and real-world asset integrations, that utility becomes a persistent driver of token demand rather than a temporary fad. Taken together, these conditions make the gateway argument plausible. Large investors, custodians, and funds find it operationally simpler to allocate to a high liquidity, broadly used token that also provides direct operational utility in the chain they intend to access. For traders and allocators, this dual role, asset plus utility token, can be immensely attractive because it blurs the line between pure speculative exposure and productive treasury-level holdings. If BNB becomes the first large token that many organizations hold as both a reserve and an operational unit, the natural consequence could be a reshuffling of capital that prioritizes projects in the BNB ecosystem, accelerating an altcoin season where BNB native tokens lead initial outperformance. This is the optimistic roadmap. BNB sustains its price strength. Institutional treasuries keep accumulating, token burns reduce supply, and ecosystem adoption continues. Together, these dynamics produce a positive feedback loop that funnels smart money first into BNB, then into BNB chain projects. But the bullish story has real structural counterweights that anyone managing risk must respect. First, concentration risk is non-trivial. BNB currently accounts for a dominant share of the exchange token segment. Estimates put its share around the 80th percentile of that cohort, which creates systemic exposure in times of stress. If a structural problem hits Binance as an institution or the BNB chain experiences a major technical or security incident, the concentration could turn into a liability that ripples through the entire segment. Second, profit-taking and leveraged positioning are beginning to show up. After a long run of gains, medium-term holders have been observed trimming positions, and leverage in derivatives can exacerbate short-term volatility. That means that while BNB's price can move sharply higher on positive flows, the same mechanisms can produce steep pullbacks if whales or leveraged players decide to rotate gains into fiat or other assets. Recent quarters show instances where aggregated profit-taking by midterm holders corresponded with sudden price corrections. Behavior typical for assets that have seen fast appreciation. The presence of leverage adds a mechanical risk. A single liquidity event can cascade as forced liquidations compound price moves, converting a nominal pullback into a larger correction. Another key risk is the narrative versus fundamentals timing mismatch. Institutional interest announcements are powerful, but approval cycles, internal governance, and risk management frameworks mean that public statements do not instantly translate into deployed capital. A company announcing a treasury strategy involving BNB may take weeks or months to actually receive funds, set up custody, and book the position, during which market conditions may change, valuations may move, or countervailing regulatory developments could intervene. That's the difference between an announced intent and realized permanent demand. Similarly, the burn mechanism is impactful only if transactional activity remains high enough that burn tokens represent a meaningful percentage of circulating supply over time. Burns alone do not guarantee price appreciation if demand is insufficient. Regulatory risk is a live and present factor. Binance and BNB have been subject to elevated scrutiny across jurisdictions at times in recent history, and any renewed enforcement action or restrictive regulatory guidance could impair Binance's operational flexibility or the willingness of institutions to hold BNB as a treasury asset. Institutional allocators are sensitive to custody and compliance constraints if regulatory opacity persists. Institutions may prefer assets with clearer regulatory frameworks, which would limit the potential for BNB to serve as an institutional gateway. The interplay between regulatory clarity and institutional adoption therefore matters enormously for the gateway thesis. A favorable regulatory outcome would turbocharge the bullish narrative, while adverse actions could snap the narrative back to a cautionary stance. Liquidity dynamics are another subtle but decisive variable. Large corporate holdings reduce exchange float, which in low liquidity environments can support higher prices, but they also create sell pressure risk if these holders decide to rebalance. The scenario in which many corporations hold BNB as a treasury reserve assumes these holders are long-term and insulated by governance mandates. Instead, they act opportunistically and distribute into rallies. The market could see periodic swoons. Also, derivatives markets and market maker behavior will define whether a rally is orderly or violently squeezed. Heavy futures, open interest, and crowded longs and low-depth ranges make the market vulnerable to whipsaws given these opposing forces. A pragmatic approach is to treat BNB's gateway to all-season thesis as a conditional and measurable hypothesis. Rather than an article of faith, watch for the signals that distinguish durable structural change from a narrative-driven price spike. Useful on-chain and market indicators to monitor include sustained net outflows from exchanges into custody indicative of longer-term holdings, continued large corporate treasury buys that are actually deployed into custody rather than just Announced quarter-over-quarter burn totals trending meaningfully higher relative to circulating supply. An escalating developer activity in TVL on BNB, chain that signals real economic usage rather than purely speculative token creation. If those indicators align, declining exchange float, persistent corporate accumulation, rising TVL and DeFi activity, and regular burns that materially reduce supply, then the probability that BNB functions as a credible gateway increases. Substantially for traders and allocators, risk management is straightforward in concept, though hard in practice. Size positions to what you can withstand if BNB experiences a 30 to 50% drawdown. Use layered entries, establish a core at current levels and add-on confirmations such as sustained close above key.